Hello and welcome to On the Money, a weekly look how to get the best out of your savings and investments. In this episode, we're going to be covering how investors can attempt to find companies with explosive growth prospects that could potentially achieve the rare feat of becoming a multi-bagger stock, which is when a company achieves a share price gain of at least 300% or 400%. Some companies achieve the even rarer accolade of becoming a 10-bagger stock. As it implies, a 10-bagger describes an investment that has the ability to or has achieved a 10-fold increase, which is a 900% gain. It was coined by Peter Lynch, one of the best-known investment gurus of the 20th century. The 10-bagger term is a baseball analogy. Joining me to discuss this topic is Jean Roche, fund manager of investment trust Schroder UK Mid-Cap Fund. Jean, it's great to have you on the podcast today. Now, Jean, as I've just mentioned, it is rare that a share becomes a 10-bagger, but it's not impossible. There are various examples of companies that have become multi-baggers or 10-baggers. Now, in the pursuit of a potential multi-bagger, what are the key ingredients or attributes that you would look for?
Yes, it is rare, and that's why I'm very proud to say that it's actually more probable, according to our research, in the UK than it is in the US to find a multi-bagger. Let's just say multi-bagger, not sort of a stick rigidly with 10 baggers, so multiple times return of your original investment. So our analysis, published a few years ago and refreshed last year, showed that over the previous 21 years, you had more of a chance of stumbling across a multi-bagger in the UK than in the US. Now, that was obviously very irritating for some of my US colleagues when I unearthed that together with my colleague, James Goodman. And so just to give you some of the numbers, what we found was when we looked at, over the last 21 years, the return of 2,200%, so that's 21 bagger. We decided to look at that. We saw that 3.6% of the investable set would get you to a multi-bagger in the US, but 3.8% of that investable set, so it had to have a minimum market cap of 150 million, 3.8% of that set was a multi-bagger in the UK. So therefore, higher probability of stumbling across a multi-bagger in the UK than in the US. So it depends on the periods you look at, but fairly consistently we were finding that. So you were asking about the key ingredients or attributes that we look for. So what we did was we turned that analysis on its head and then looked at the attributes of those UK companies. What was it they were doing that was managing to get them to this sort of status. So companies such as Games Workshop or Cranswick, for example, the food manufacturer. A key finding was around issuing shares. Multi-baggers don't really do it. And that's what we found. They don't issue. If they issue shares, they don't issue very many because issuing equity is damaging for returns more generally. And they don't have to issue shares because they're able to generate cash internally. And then crucially, they use that for investment. But of course, they must be profitable in order to be generating that cash in the first place. So, you want these company models where they're profitable and all the other good things you would expect, like strong management and in a sector where supply can't keep up with demand and they have pricing power. But I think the key factor to focus on really is that generating that cash, the cash returns, and then investing that.
And is there a minimum threshold you're applying to be a multi-bagger? Is it got to go up 4 or 5 times?
Yes, I think that's a really good question, actually, because I was discussing this with the family last night. They were absolutely delighted. My 2 sons, both under 15. But they asked me what a multi-bagger was. And I said, well, if you think about it like a multi-story car park, if it has 2 floors, is it a multi-story car park? If it has 3 floors, could you say? So if it's 3x, maybe 4x, I think that's kind of what people have in their mind. But also what I did find was some of the literature says it has to be the capital appreciation only, doesn't count the dividends. But actually, I think it must count the dividends because that's what the shareholder experiences they can see, and then it's whether they decide to take those dividends or reinvest them. But if you decide they're going to reinvest them in the shares, it's that crucially gives you that exponential return over and above. And actually, we really see that in mid-caps because they're at this sweet spot in their growth stage, where you get the capital appreciation and then the dividend on top. So I'd say, what do you think? I'd say it needs to be 3x, 4x before you're talking, or maybe 5x. But I think it's a healthy debate. But the multi-story car park worked well as an argument in our house.
You mentioned Games Workshop and Cranswick. In 10, 15 years ago, these would have been less familiar names with investors. So do investors need to look outside the bigger names in the FTSE 100 to try and identify companies with potentially greater growth prospects?
Yes, and I think it's intuitive really, isn't it? If you start with a 10 billion company, let's say, for it to be a 10 bagger, if we go back to just 10 baggers versus, a £10,000 or a 1 million market cap company, you kind of think if you start with that smaller company, then it's more likely that you can increase by that multiple. So that's a good place to start. If we accept that normally 10 billion companies are not going to 10x. So then we look at why would they start to, increase in, so if they get multiple expansion, and how do they get multiple expansion? Because more people start to know the name. As it starts to prove itself, more people get interested in it. It's under-researched in the beginning, so that's where the opportunity lies. So obviously, small and mid-caps tend to be less well-known, and particularly less well-known by international investors. So as international investors start to get on board, and often we find that's the sweet spot. You see the first couple of American investors appear on the register. And I remember back in the day, I covered ASOS sort of 20 years ago, and in its time, that was a multi-bagger over a certain period. And when the first phone calls started to come from, say, West Coast hedge fund about the stock, then you start thinking, well, now you might see the multiple expansion. So if you get together with the top line, the revenue growing, together with the margin expansion, together with the multiple expansion, so say the top line doubles, the margin doubles, the multiple doubles, you've got an 8-bagger there. So it depends on the amount of time you think that might happen. I think that's the real kicker, is when you start to get the multiple expansion, because more people start to know it.
And are there certain sectors or industries that you would highlight that have potentially higher growth opportunities?
Yeah, well, it's counterintuitive in some cases. Some, like Cranswick, for example, you wouldn't think food manufacturing would be your ultimate sort of multi-bagger hunting ground, because you would think high return on equity sectors, high return on invested capital, low capital intensity. Well, of course, Cranswick, which does pork products and chicken, they actually generate lots of cash internally, tick the box, don't issue shares. But, they do, high level of capital investment is required there, but they actually make that investment. And then they get the return on that. And then they're also able to return cash on top of that to shareholders in the form of dividends. So that's a sector where you wouldn't expect to find it. And that's a stock that's actually a 200 bagger plus. So you're very interesting. So that's maybe an anomaly. You wouldn't traditionally look in that sector. You'd look in sectors like IT, industrials, consumer discretionary, healthcare, financials typically. So they would also be lower capital investment required generally, and double digit profit margins typically. But you can find them in all sorts of sectors, and that's sort of the interest and the joy in researching these things. When you get that glorious, excellent management team on top of the right sector and the lack of supply of whatever it is they're doing. And in the case of Cranswick, you've got the lack of people being able to do something complex, which is food manufacturing, handling raw meat, and being able to do that well in a consistent way.
And could you highlight examples within Schroder UK midcap that have been multi-baggers over the years?
I thought you'd never ask. But I've already mentioned Games Workshop and Cranswick. But I think others that, depending on, again, when we've done the analysis, others that have popped up on our screen that have been multi-baggers, we can, look in a alphabetical way, if you like. So we would have had Ashtead, which is equipment rental, which obviously sadly has gone to the US now. Computer Center, generating very high levels of cash, paying it back in dividends and special, and then reinvesting that cash. You've got Diploma now in the FTSE 100, Granger as well, not a multi-bagger if you cut the data currently, but when we did it 2 years ago, it was. And that rents out accommodation to people, high quality accommodation, private rental sector, and as you know, shortage of accommodation in the UK and strong management team there. And Savills as well. So, they're, household or at least broadly recognizable names. But one of the things is, they arrived, they became multi-baggers, but what you then need to do is look for your next multi-bagger, which is why it's quite a useful discipline. And we do that in the trust that I run called Schroder UK Midcap PLC. What we do is, and the philosophy within the team, together with Andy Brough and James Goodman, is that we sell a mid-cap when it goes into the FTSE 100 for these strategies. And then we look for, ideally, the next multi-bagger at the lower end of the market cap spectrum, which is hopefully not very well known. Going back to what we said earlier about starting small, because a lot of the multi-baggers, if you get sort of the printed lists of stocks in the 90s, the small caps, you'll see some of those multi-bagger names. I mean, Schroder, for example, is a chemicals company, not currently doing that well, but that was flagging very strongly as a multi-bagger a couple of years ago. Now it's had a more difficult time recently, but you would have seen some of these sort of twinkling away in the small cap. So that's why it's really great in the team that we have a small cap angle as well. So, we look at things coming up from small cap and then waiting for them to move into mid cap, and we invest in them then in our mid cap funds, and then and then we'll move on from them when they make it into the FTSE 100, hopefully.
You've mentioned your sell discipline. If a company enters the FTSE 100, you'd sell. Prior to that, if a company's having a good run up in share price, how do you decide whether to take some profits or keep on running it as a winner?
Yes, I think that is one of the key disciplines, remembering to sell, not falling in love with a share. But of course, what we find is we didn't buy the position all at once. We went into it slowly. We didn't suddenly put 4% into the fund, because often these stocks they move to become 3, 4, 4.5% positions in the fund. So it makes sense to top slice. We look at PEG ratios particularly. So when the PE divided by the 3-year forward growth forecast in earnings per share is looking a bit out of whack with where it's been previously, perhaps that might be time to do a bit of top slicing. And as I mentioned, 99 times out of 100, if it goes into the FTSE 100, we'll sell it all. And actually by then, having to slightly contradict what I just said, because it's going into the FTSE 100, it probably has good enough liquidity at that point that you can actually sell it all. Whereas when you were buying it in the early days, hopefully right down in the bottom of the mid 250 opportunity set, it wouldn't have been possible to buy that position all at once. So, you can actually sell quite quickly when it's being promoted. It's widely anticipated in many cases as well, but probably before then you'd have been averaging down, selling, not averaging down, but selling down, top slicing it, yeah.
And your decision to do that, so if a mid-sized company becomes a larger company and enters the FTSE 100, your decision to sell, that's an internal decision, because I do know that other funds and investment trusts, smaller company funds, I have often seen certain holdings enter the FTSE 100 and then they're still in the top 10 holdings.
Yes, yeah, and they can occasionally keep going, but we generally find, I think, one company where we have given example in the past is, say, for example, Fraser's, which would have gone into the FTSE 100 at £8.50 and then come out of there and, traded around down as low as below £3. It has often been the right thing to do. And the company formerly known as Royal Mail, then IDS, now obviously has been taken out. That one got promoted into the FTSE 100 twice and fell out twice. And both times it was actually a good trade to do, to buy it when it fell out and sell it when it went back in. So generally we find that it also forces us to look for new ideas down at that small cap sweet spot part. And it might be you end up buying 2 new ideas to replace that one idea that went out through the sunroof, shall we say. And we're always waiting, very happy to have another look if something that's got promoted comes back to say hi in the mid 250 again. But I think, sometimes stocks keep on going. And I'm sure there'll be people who say, I would hold on to them. And I think, as you would expect, that is a live debate. And you will, if you have a little look, you'll probably see a few Games Workshop shares still lingering, which is now in the FTSE 100, of course, in this fund. So I did say 99 out of 100.
Wanted to next turn my attention to your portfolio at the moment. Could you highlight where you're finding the best opportunities at present? Are there any sectors that you pick out or types of companies that you have in the investment trust? And could you run through some recent portfolio activity over the past couple of months?
Yeah, so I should probably mention, and I think it's been highlighted before, where we see inexpensive technology stocks. So they're disguised as defense stocks, but they're actually, in our view, inexpensive technology stocks. And that's where we have been fairly over-indexed recently. We had Babcock that got promoted into the FTSE 100, so we don't have that anymore. But at one point, 12% of the fund was in defence. And actually, I went to DSEI yesterday, which is the biggest defence showcase in Europe. And that's ongoing out in the Excel Centre right now. But you can really see that is where, in an environment where growth is low, and of course the UK has higher growth than many other G7 countries right now, but in an environment where generally growth is hard to come by, that is a sector where we are going to see growth. And of course, it's important to lean into certain stories within that. And you'll see positions like Chemring in the portfolio. And we also hold Kinetic, which generates a lot of cash too. And you can also see in IT services as well that an inexpensive technology stock. Again, I'd class Kainos as one of those. And they do workday services and solutions. And there we had the CEO come back into the business, and we've really seen the fruits of that as it moves to recovery. So, in that sort of inexpensive tech stocks bucket, that's where I put some of the defense names and some of the IT services. And in terms of recent activity, adding to that name, Kainos, for example. And then recently, activity is then pushed by, for example, bids. And as you know, there's been a huge amount of bid activity in mid-cap land, just really highlighting the fact that the US strategics, the US financials are getting really interested because they really see the value inherent in these UK companies where multiples have been driven down by flows out of funds, really. So we've had a bid for Spectris, the scientific instruments company, at nearly 90% premium to the resting price, and also for Just Group, the financials, the bulk purchase annuities specialist. And so then, as you would expect, we're looking for replacement ideas for those. So maybe adding to existing positions in, I think, world-class industrials such as Bodycote, which does high-pressure engineering, where it presses pieces of metal down harder to make them work better for longer and have higher fidelity in machinery. I hope you're not an engineer. You could probably explain it better than me if you are. And so, what we might be doing is sort of adding some of those existing positions in industrials. And then with Just Group going out looking for a replacement in that area, in the insurance arena. So, sort of replacing that industrials exposure with further industrials exposure, and then replacing the Just Group, which had that bid as well, with replacement ideas in the same sector. So, and I think it's fair to say, I would have highlighted, 3 or 4 months ago, if we'd been sitting here, I probably would have said I was leaning more into UK names. I would say now probably more into international names, because some of the UK names did run a bit. Some we've seen some warning signs, some sectors starting to look a little bit more shaky on the domestic side, and you have to be very careful with, for example, which part of the consumer discretionary you lean into. So which consumer you're exposing yourself to. For example, Currys have had a really good run of it, but they are exposed to the AI super cycle in that they've got the highest market share of AI-enabled laptops in the UK. Do you have one yet?
I don't actually know.
Oh, you've got to get one. But that's kind of something, and that together with, you may have heard some of their ads. They have very amusing ads. I don't know if they're being targeted at me particularly, but they have some very good marketing out at the moment also. And, you've had the competition just fall by the wayside. Gone are the days of where you'd go to John Lewis and get them to explain your new TV to you. That just doesn't happen anymore. So it's wide open for Currys. And they also let my boys play on their, on all their gaming, sit in the gaming chairs and play with all their various tech kit. So I think the store experience is strong there as well. And people are refreshing that kitchen equipment, consumer tech, having bought new stuff in 2020 during COVID. After 5 years of eating your lunch over a laptop, it's not very nice. So maybe you want to buy another one.
And finally, could you provide an outlook for the area of the market that you invest in? I was hoping you could name one reason to be cheerful and one reason to be fearful.
You're limiting me to one of each. Okay. So just to recap the area of the market I invest in. So we focus on the mid 250, which is the 250 companies below the FTSE 100, excluding investment trusts. So that's an index which then gets you to about 170 companies. So that's the area that I'm very focused on. Reasons to be fearful. I think, the Daily Mail and others will cover many, many reasons why you can be fearful. But the main reason to be fearful is fearful of overpaying for a stock, because that is what destroys returns. And that's the key. Actually, going back to the multibaggers, I should have said earlier, the price you get in at, there are very much timing disciplines with getting the multibagger equation right. So that initial valuation point. So that, the fear of overpaying, and I think PEG works well for that. What am I paying for this growth? Because it might be a great story, but the valuation isn't going to go to the sky. So I think what keeps me cheerful, I think I need to say this quickly as one sentence so you won't notice. I have a few. So knowing individual stocks gives me great pleasure. I think I talked about Currys a fair bit, for example. Knowing management teams, having a fierce attention to accounting detail alongside the team. There's a lot of CFAs and accounting people on our desk, and I think that is what makes me cheerful, because I can always find a data release with some positives. For example, we're one of the fastest growing nations in the G7 by 0.1% or something, but you'll always find another piece of data to contradict that. And that's why you classically see those arguments in government where one politician says one thing, unemployment's come down and employment's gone up under the Labour government. Well, you could actually argue the other way around as well, depending on how you cut the data. So, and we're winning the least ugly competition with France. But again, I'm not going to cling to that. It's about the individual stocks. And so what makes me cheerful is meeting management teams, alone or with colleagues, doing the work and then getting it right. Getting in at the right price is the cherry on top.
So that's all we have time for today. My thanks to Jean, and thank you for listening to this episode of On the Money. If you enjoyed it, please follow the show in your podcast app and do spread the word. And if you get a chance, please leave us a review or a rating in your podcast app too. We love to hear from you. You can get in touch by emailing otm@ii.co.uk. And in the meantime, you can find more information and practical pointers on how to get the most out of your investments on the Interactive Investor website. And I'll see you next week.